me make sure that we have everything ready to go. And if everybody can mute themselves, and I'm going to count to 3, and then we're going to start the broadcast. Everybody, and welcome to the conference series, sometimes known as Successful Investing 4. These programs have become a place where ideas are born and shared with everybody in our community. Tonight is an old-fashioned, no-holds-barred stock panel. We've been doing Let's Talk Stocks now for about 16 or 17 years, and we're very pleased to bring you our picks for stocks that we think are extremely interesting, but we have to disclaim just a little bit. First of all, I'm going to introduce our panelists to you. We have Kim Butcher from Florida. Kim is down in sunny Florida with her mom right now. Kim has been on the Better Investing Volunteer Advisory Board. She's in a couple of investment clubs, and she's certainly a good stock picker when you ask her to step forward and give you some names. We have Ann Cuniaz. Ann's from our headquarters office, and Ann is in charge of our complete educational program. We are so lucky to have Ann with us tonight. She always does a beautiful job when you ask her to give some stock ideas. Ann's going to come out with classic up, straight, and parallel stocks, and listen carefully, because Ann has told us at various times on various stock panels to watch companies like Microsoft, which in our estimation has become the best performing stock in the last 8 or 10 years in a lot of the portfolios that we've been watching. So listen to Ann and what she says tonight. Pat Donnelly from the Pittsburgh chapter. Pat is currently serving as president of that chapter, and he's also sitting on the NEIC Better Investing Board. Before that, Pat was a chairman of the Volunteer Advisory Board, the BIVAB board, and Pat is a dear friend and quite a raconteur of Irish wit and stories. All he needs is a little bit of a wind-up with maybe a ale or two, and he's going to keep you busy for the rest of the evening. Charlene Hansen is the president of one of our model clubs, the one up in Elk Rapids, Michigan, just east of Traverse City. And Charlene is the president of that model club, and she's become quite an on-point stock picker. We're very pleased to have her with us this evening. This marks her second time on our panel. My name is Ken Kabula. I'm chairing the Mid-Michigan chapter. I've chaired the Better Investing Volunteer Advisory Board for a long time, and I met lots of you at the conventions that I ran for a number of years for Better Investing. Our next panelist is Cy Lynch from Atlanta. And Cy is on the Better Investing NEIC Board of Directors along with Pat. And Cy is also a noted teacher, and he just does classes for folks all around the country. I'm sure that many of you have heard Cy teach, and you're very understanding of his abilities and of the deep knowledge that he has about the investment club movement, this grand experiment that's been 80 years in the running right now. And finally, Mark Robertson of Medifast Investing, formerly an employee of the Better Investing family, worked on the magazine for many, many, many years. And we're just lucky to have Mark so nearby and so willing to help us out whenever we ask for the kind of help that he's willing to give us. Mark is a great friend. He and I travel all over the country, sometimes by plane, but a lot of times by cars. You'd be surprised at all the problems we can get solved on a 5 or 6 hour car ride. I just wish that we took notes and kept those notes and filed them so we could remember for the next time we had that car ride together. That's our panel today. We're going to be sharing some stock tips with you. Here's a disclaimer. We are talking about actual stocks in real time. We are not making any any recommendations to buy, sell, or hold any of these securities. Our goal is to give you ideas, and we'd like you to be the one that takes action on those ideas. Do your homework, study the stocks, and if you think they belong in your portfolio, or maybe if you think they need to be removed from your portfolio, then you make the final decision on what should be done. We're trying to empower our community to be their own financial advisor and their own financial analyst. We might hold some of these stocks in our own portfolios, and if we do, we'll try to let you know as we make our presentations. If you'd like copies of the slides tonight, then please, you can send an email to Mark R. at manifestinvesting.com, and he'll send you copies of the slides that we're using this evening. And finally, if you'd like to listen to anything at all in this particular series that we've been doing, or in any of the Mid-Michigan projects, you'll find all of our materials are posted on YouTube. The name of the channel is the Manifest Investing Roundtable channel on YouTube. If you subscribe, then you'll get an email telling you whenever we put new material up there. We've been posting material there now for close to 11 years, and you'll find lots and lots of great historical stuff, but also all the current things that we've been doing in the last year and a half since COVID has kept us at home. Let's move to our conference agenda. This is the culminating class in our conference. We went through 2 classes yesterday and 1 class this afternoon, and now we're going to have some fun. We're just going to sit down and talk stocks. Nothing about portfolio management, nothing about trying to do fancy things. We're just going to talk good stock ideas. And we're going to start by looking at what we've done in the last 3 conferences. We have to remind ourselves that these are very short-term results, and as better investors, we're long-term investors. But you can see that on our first COVID Constellation Conference 2 years ago, our picks outpaced the market quite a bit. In the second conference, we're lagging the market, and in the third conference, we're also lagging the market to date. This was only 6 months ago. I think many of our panelists would tell you that our kind of investing takes patience, discipline, and a little bit of time. And 6-month results, even 1-year results, are not the kind of results that we would use to measure the success of our picks, whether they're positive or negative. Our panel selections from May 2020 are in the slides, and you can take a look at them. Mark wanted me to say that before we get off of this slide, Pat Donnelly's choice of Stone Company, which down here is second from the bottom, right after we had the conference a year and a half ago, Pat Donnelly's choice soared from around 22 to around 90. That was certainly a time when if you had bought into his idea, then you probably wanted to think about exiting that particular stock, because as it soared towards 90, its par value soared down to near 0, its potential annualized return. It's since come way back down, and that's why you see the only $30 price. It has a 21% total return. That's nothing to be sneezed at, but the market during that same amount of time has gone up 44.6%. We have been in one hot market. Here's our selections from November 2020, and the selections from May 2021 are there as well. If you ask Mark for the slides, then you'll get these selections. You'll also be able to see them on YouTube as we post this on the YouTube channel. So, without any more from me, let's listen now to Kim Butcher. Kim is going to bring us a brand new stock to the market called Cricket, ticker CRCT. Kim, take it away.
Welcome, everybody. If anyone in this audience has a family member who likes doing crafts, then they know about crickets. And for the guys out there, if you don't know about crickets, basically it's this machine that you will see there in the picture, and it lets you print banners. You can buy a little machine smaller that you can buy those wine glasses, and you can make your own fancy labels for it. You can do shirts, you can do all kinds of professional looking items for the crafter, cards, banners, everything like that. I found this stock because I go to Michael's a lot, and I just don't have the time to do it as much as I would like to, but they have this cloud-based software that lets you have pictures and fonts so that anyone can do what they want. And ultimately, you've got a lot of people doing side hustles making money off of this. So if anyone's on Pinterest or Etsy looking, a lot of them are using this Cricut to be able to make it. And I believe Ken even mentioned his daughter does a lot of scrapbooking, and what is it? What else does your daughter do, Ken, with it?
It's basically scrapbooking, Kim.
Yeah. So there's a lot of accessories. You can do this on regular cardstock. You can make banners. I'm really tempted to buy the little machine to make my own wine glasses with labels on them and stuff like that. So it's crafting, but because they have a subscription model and it's a reoccurring revenue item, I thought it was really interesting. Now, it's not been on the market. It doesn't have 5 years of data right off the bat. I'm going to tell you that. But creativity is very universal. And if you think about it, in the third quarter, just to let you know, they reported out this week. So these slides are all fresh from this week. But the internal revenue came in of growth of 110%. And if you round that up year over year, they're going into new markets, the Middle East and Hong Kong. Direct markets, they've got UK, Ireland, France, and Germany. And they actually have a lot of the expanded retailer of the footprint where you can go into a store and do all this. Now, I've always been taught that I like doing stock research by going to stores or sampling items. And I went to Michael's, and I was shocked to see that they had 2 whole aisles of nothing but stuff for Cricut. So they're giving, stores are getting a lot of space to them. Now, in the third quarter, they had revenue that increased year over year by 24.4%, $260 million. So this is a nice small cap for you. Net income was $30 million, which is 11.5 of a net income margin. EBITDA was increasing by 16.4. They're increasing their users by almost 56% year over year growth. Their users are engaged in buying more by 37.4%, and the ending paid subscriptions on that reoccurring revenue that they have was 55.8. Great numbers, all of them. Next slide. Now they want to expand, and in expanding, they're going to have that international growth. We all like companies to have international growth, and they really believe that they only have a 4% penetration of that kind of growth. So their total active users of their abbreviation is SAM for active users, or number of people, was 129 million. International were 44 million, and US and Canada 85. So they got lots more growth to happen. Here's how their revenue is broken down into 3 different segments. The connected machines grew 36%, and subscription revenue grew 71% if you round it up. And then they have accessories and materials. So there are 3 different drivers of the connected machine: subscription revenue and accessories and materials. As I said earlier, their international revenue grew almost 110%, which was that was only 12% of that revenue. And it's 46% pre-pandemic cash adjusted growth rate from 2014 to 2015. So in that 5-year period, it's almost a 50% growth, or 10% a year. So they're getting things done. They're growing, and that's what we want for those companies we have. Next slide. You can see in the last 2 years how users had increased 158%. Their 90-day engagement has increased 140%. Paid subscribers, and they're getting more and more because they're offering more and more things in that subscription base for people to be able to have access to. 238%, nothing too shabby. There you go. Next slide. Their subscriptions, you can see how they're growing that way from $6.41 all the way up to $9.60. Now, if you look at that kind of growth, people, that's nothing to be shabby about. Their accessories and materials have gone down a bit, but that's also because they found out that where they were getting their supplies in China, you know, we have these shipping delays. They're now getting a lot of that moved to Malaysia to make that better, but they're still having issues. So supply and demand, they've got a lot of demand, but they can't get the supply. So in the last quarter, when they reported out this week, it wasn't exactly what the market expected. Next slide. Obviously, you can see, look at these margins. Would anyone complain of these kind of margins? 28, 42.8, 39. If you take out third quarter of 2020, the middle of the pandemic when everybody was stuck at home, and then you go from 28 to 40, you can see that that kind of growth, how do you complain about it? Their balance sheet and cash flow highlights are really doing well. They have $224 million of cash and cash equivalents on the balance sheet, and they still have $150 million of credit line, which remains untapped. Their cash flow for operations year to date, they still have $132 million by building inventory to trying to avoid that supply chain risk. Next slide. This is how they feel they have the growth and the market opportunity by making improved ease of use and the user experience, which will reach and acquire more users because they are on all the social forums. And a lot of their new subscription members who get on are all by word of mouth, because we ladies like to talk to the other ladies telling us what's the easiest way to do something. They like increasing that monetization from the current users, launch new products, expand internationally, grow, grow, grow. Next slide. This is what it was in the PowerPoint saying as what their targets are. Ultimately, they want gross margins up to 38%, R&D expense 7 to 8, S&M expense only 8 to 10, G&A expense 3 to 4, and their EBITDA margin 17 to 20. And see how that has been growing year over year. Next slide. So their revenue increased 24.4%. The market expected that to be $267 million for sales. So it wasn't as much as expected. Estimate of 16% for earnings per share, and it was 13%, or 13 cents. Profit margin dropped from 48.8 to 39.2. And let me tell you something. Do you really think a profit margin of that much difference matters? Next slide. This is the front of the SSG. We don't have 5 years of data. So going forward, each of us will have to make our own judgment as to how much growth are they going to be able to do. Next slide. When I did mine, I put growth of 25%, earnings per share 25, keeping it the same. I had a buy price 4-to-1 downside. Closing price was $28.90, but today they had a nice little pullback of another 15%, and it was at $23.65 is what the stock closed at today. Upside downside before the pullback today was 4-to-1, and as long as you bought the stock price below with the because of the zoning below 32.5, well, it's definitely at that now. Also want to make sure that you guys all realize, look at who your insiders are who are owning it. and ABDIEL Management and Abdel Capital Management has been buying up the stock. I think right now they have over 25% of the shares. So I want you to be aware of that. My next thing is, because they've not been out there for a year, they don't have that first proxy, and I try to go through all the old filings to see if we had anything for what the executive compensation was, and I have to admit I hadn't been able to find it yet. So here's a small cap stock for you to take a look at.
Thank you, Kim. Let's introduce Cy Lynch. He's going to talk about Ollie's Bargain Outlet, stock ticker OLLI. Cy?
All right, thank you, Ken. And some of you may have noticed somebody's name near the top of most of the results earlier. And in keeping with my traditional picks last May, a year and a half ago, I think it was my lightning round pick, was a retailer that didn't have any stores open because of the pandemic, Five Below. So we're going to do Ollie's Bargain, which has stores open because, of course, now virtually everything has resumed at least being open. Besides just mentioning that, I do say that you notice that Ollie's has a pretty good, consistent track record, very consistent sales growth, reasonably consistent earnings as well. But you notice a little bit of a pullback there in the second quarter of fiscal 2021. And that's pandemic related in that they're having some margin pressures because of some of the supply chain issues that we hear about. But the other reason for the pullback, and it's probably going to continue for the rest of the year, Value Line seems to think, as well as management, is that they had an extremely good second quarter last year coming out of the pandemic. In the quarter ending in June, their sales quarter over quarter were up about 60% compared to a normal increase of about 3%. And that continued the rest of the year. So they're in the position of relatively unfavorable comparisons year over year. But again, probably temporary things, gives me confidence looking at the history. Next slide. And also I will mention that while you see 7 years of data, that's how long the company's been public. The first Ollie's actually opened in 1982, and they had 100 stores in 2011, about 10 years ago, and they're over 400 now. So they've been around a good while. As far as where I got the company, I took a look at the roundtable portfolio, ranked the holdings by par, and was just looking at companies I was familiar with or that I had brought into the portfolio. VMware happens to be kind of the highest return and quality there. I've marked that. So I said, but I don't want to do VMware, but let's screen against that and see what comes up. Next slide. And here's what came up. There's a number of interesting ideas here. I circled a couple of reasons that I chose not to go in the direction of Skyworks. Earnings stability, again, given the current market, I thought I'd like a little bit more earnings stability than Skyworks was showing. Global payments certainly looks like it could be interesting, but I didn't really like a 43 PE, especially when I could get the same growth at a 28 projected PE with Ollie's. So I said, let's take a closer look at Ollie's. Next slide. Here's the industry that they're in on Manifast. Quick industry study. You see Ollie's is the highest ranking quality, although really those first four are all excellent quality companies. Not a whole lot of variance, but Ollie's is the only stock that's in both the sweet spot over our goal of 5 percentage points above the market, and excellent quality. So that made me say, let's look deeper at Ollie's. Next slide. Here's briefly what it is. They're a discount store, but they seek to be a little bit more fun than other retailers. They poke fun at themselves and at the market. And they sell closeout and excess inventory. You see some of their wit there in saying they have 422 semi-lovely stores, and they're in 27 states. Their goal long-term is to grow to at least 1,000 stores. They think that they have the market to be able to do that. Next slide. And here's where they get their product. They buy from manufacturers, just their overstock or their seconds or whatever. Sometimes financial institutions liquidate. Companies end up with inventory that was their collateral, and Ollie's buys from them. And they always have their no hard time. We'll give you your money back in 30 days. And actually, I just noticed in looking at the website today, preparing for tonight, they, like many retailers do, actually right now will extend that guarantee through the end of January for the holiday season. Here's the company, and I won't read the slide to you. They primarily say that they're highly experienced, and they do have a loyalty program, Ollie's Army, that's been around for a while, that appears to be a very loyal customer base. But what they really stress is it's a treasure hunt. You never know exactly what you're going to be able to find when you come in the stores. So they encourage repeat business by come on in and see what we have today at good values. Next slide. Here's just a assortment of the brands that they stock. Again, they are not in the mode of a Dollar Tree or even really a Dollar General or Family Dollar in that they sell their own brand of products or products that are prepared just for their stores. They are buying primarily name brand items that you know that they can get very cheap and then sell cheap. Next slide. Unique, fun, and engaging treasure hunt shopping experience. You see at the beginning of this slide, and again down at the bottom, they mention they're stressing on humor and trying to be a fun experience. Next slide. Here are my judgments. I projected 11% sales growth, which is right in line with Value Line's projection. And then the pre-tax profit and tax rate. The tax rate comes from Value Line, and I think it's reasonably close to the last quarter. Their tax rates are going up, which is not unusual, again, as companies adjust to the 2017 tax rate. Shares outstanding, again, comes from Value Line, gives me a $4.64 next projection for EPS. And then using a high PE, I come up with just less than 21% potential return, or using the average PE, which is in line, I think, with the Manifast consensus, actually just a tick below. I think Manifast consensus is 28. It still looks very strong at 12.3%.
Well, thank you, Ollie. Ollie, thank you, Cy. I think we'll all be looking for Ollies for our shopping experience in the next week or so. Let's move on to Charlene Hansen. Charlene's going to talk about Skyworks Solution, ticker SWKS. Charlene?
Hello, everyone. And Sai, hopefully, or maybe I'll alleviate some of your fears about the earnings stability for Skyworks as we talk about it a little bit. As Ken said, its ticker is SWKS. It's on the NASDAQ. It's a medium-sized company. The sector is technology, the industry, semiconductors. Skyworks produces semiconductors for wireless handsets and other devices. Its main products include components that support wireless transmissions. Skyworks customers are mostly large smartphone manufacturers with 56% of their business coming from Apple. But the firm also has a growing presence in non-handset applications such as wireless routers, medical devices, and automobiles. The metaverse is a newly coined word of use of a new word. It's typically used to describe the concept of the internet made up of virtual spaces linked into a virtual world or universe. The metaverse, in a broader sense, refers to the entire spectrum of augmented reality or a collection of CD worlds. Facebook announced their new name creation Meta platforms from this word, but anyone looking for plays on the emergence of the metaverse could also consider Skyworks. Slide 2, please. The slogan, connecting everyone and everything all the time, attempts to showcase the wide range of Skyworks' expertise in autonomous vehicles, connected homes, wearables, emergency response, industrial automation, location-based services, infrastructure, telemedicine, artificial intelligence, and smart cities. Next slide. Let's talk about 5G rollouts. Devices with 5G connection will be even more complex, making Skyworks' expertise even more valuable to device makers. Skyworks is one of the few firms with the scale to supply hundreds of millions of RF products per year, giving it a leg up on new entrants. RF modules are a small electronic device used to transmit and/or receive radio signals between two devices. And although the company faces an intense competitive landscape, it should succeed in the coming years as the handset industry focuses on 5G. Skyworks' ability to integrate a variety of RF parts into a single package has been difficult for others to replicate, and Skyworks has reaped the rewards with healthy profitability and earnings growth. Next graph, please. Skyworks Solution is an old friend, owned by our club years ago and made us a lot of money. We sold it when it flattened out around 2017, and we invested in Amazon then. It now appears to be on a new upward trajectory. Each of the last 4 quarters, they have achieved strong revenue and earnings growth. The Analyst Projections, those little round dots that go farther out, they show the expectations for the continued upward momentum. My forecast for revenue at 12% and earnings at 13% is more conservative than the analyst consensus estimates because large customers like Apple and Samsung wield significant pricing power and could exert pricing pressures. Connectivity is the future, with technology experts predicting there will be 75 billion connected devices operating worldwide by 2025. Skyworks is uniquely positioned to capitalize on emerging 5G and Internet of Things opportunities. Next slide. This chart shows other things I like about this company. Shares outstanding, the top blue line, continues to go down, increasing shareholder value. Free cash flow, the purple line, is strong and rising, and dividends, the lime green line, shows that dividends have been consistently increasing. They also have exceeded earnings estimates 4 of the last 4 quarters. Usually I would review the evaluate management section of the SSG at this point, but I'll cover it later in my presentation. Next slide. To determine the potential high price, I considered the 5-year average high of 22 PE, then took out the 2020 outlier of 32.1, which then produced an average high PE of 20. This is a consistent and reasonable PE compared to other peers in the sector. So it was used to forecast the high the high price. Next slide. The earnings per share calculated by my forecast and using 20 as the high PE, it projects a high price in 5 years of $312. This forecast is in line with Manifest Investing's and Value Line's high price projections, which range from $305 to $330. The low price projection of $120 is from figuring roughly a 25% drop in the current price. This is my own formula that I use depending on the company I'm looking at. And that formula brings Skyworks in, or the low price in at 120, which is which is lower than Skyworks' 52-week low of 134. At $164 price at the time that I did the study, and with my forecast, Skyworks was in the buy zone. But please do your own research and comparisons, as Skyworks reported their annual earnings last week, and the price has changed since the study was completed, but it hasn't changed much. Next slide, please. I like to check my compound annual return projections against Manifest Investing's PAR, and my SSG high PE forecast results in a 14.1 compound annual return compared to Manifest's 16.8%, indicating my numbers are conservative or marks are optimistic. At any rate, even if the average PE forecast is realized, I'd be satisfied with the annual return of 10.8%. And it certainly beats my bank account, savings account. Another step I always take is to compare the company I'm researching to others in the same industry. I use Manifest Investing or Better Investing search feature to easily find other high quality companies to research and compare. Next slide. For the sake of this presentation, I use a technique I often use to cut to the chase. First, I analyze the Evaluate Management section in the SSG to determine if I like the numbers and the trend there. Skyworks, which is at the top of the slide, looks to me to have healthy numbers for pre-tax profits and return on equity, and I really like their very low debt. Next, I create a spreadsheet, which is in the bottom part of the slide, with the numbers from the other companies I'm considering in the industry. After all, I'm looking for what I feel is one of the best in that industry. I then determine which ones have the best numbers and rule out the ones that have numbers that are red flags. The ones that rose to the top are Taiwan Semiconductor and Micron Technology. These are the two companies I will research and do SSGs on, and then use the Better Investing stock comparison guide features to compare them with Skyworks and determine which company is the best of the three and which is in the buy zone. The current chip shortage is putting a strain on semiconductor companies and has caused stock prices to be slipping. When supply chain problems subside, that trend should reverse. Skyworks' 52-week high price was $204. At $164 now, that's 19% decrease. In other words, it's on sale. This study will be presented at our next club meeting, and who knows, maybe an old friend will return. So happy Thanksgiving and happy investing.
Thank you so much, Charlene. Great presentation. Our Ann Cuniaz from headquarters staff is going to present Jack Henry and Associates, ticker JKHY. Take it away, Ann.
All right. Well, thank you very much, Ken. It's a pleasure to be here and see everybody. Yeah, we're going to talk about Jack Henry. And just a quick disclaimer before I get very far, I have been a Jack Henry shareholder since 2006. So I do own this company, and I want you to know that. Next slide, please. So first we'll go to the SSG Plus, where we can get a very nice overview of the company. Right there at a glance, I can see that this is the technology sector company. It is in the information technology services industry. It's a medium-sized company, specifically at about $1.8 billion worth of sales in 2021. And there's a short description there, and you can read through there, but basically they supply core systems and services to banks, banks and credit unions. And they say that they like to focus on small and mid-sized banks, and that's true. And what they define that to be is about $50 billion of assets or less. That is their target market. Next slide. So Jack Henry has really a number of competitive advantages, I think. And one of the first ones I want to talk about is that their customers are extremely sticky. And what I mean by that is that the products that Jack Henry provides to the banks and the credit unions, they're so integrated into the bank's businesses that banks rarely switch these core processing systems. Most of the contracts that Jack Henry has with its customers are multi-year contracts. And multi-year is long, tends to be on average 7 years or more, 7 years or longer. Their primary revenue streams are services and support and processing. Those are the two key groups that they kind of classify their revenues in. And these long-term results, this results in lots and lots of recurring revenue, which is a wonderful thing. Their customer retention rate is consistently near 99% every year. And they are really, really proud of their high level of customer service. They say in their 10K, this is one of their primary competitive advantages. And they talk about their 4.75 rating out of 5, which is extremely satisfied for their customers. Next slide, please. So their growth strategy is one that is focused on internal and organic growth primarily. They do occasionally make acquisitions, but they have a very disciplined approach to make these acquisitions, and they want to make sure that they're filling a gap in their product offerings, something that they're missing. These tend to be smaller acquisitions, nothing too large. Currently, they are transitioning a number of their customers from on-premise installations to what they call, or what is known as their private cloud, Jack Henry's private cloud. And Jack Henry believes this is a win-win situation because the customers enjoy, increased security and perhaps more time to really focus on their business and don't have to worry about their systems so much. And it's a win for Jack Henry because this is a higher margin product, the private cloud installations over the on-premise installations. A lot of these are moving that way. Also, they're continuously and always improving their product offerings to reflect banking trends. This is a key component of their future development. They like to keep their eye on that ball. And this strategy really results in a boost to the sales to their existing customers. And while the trends may change, Jack Henry has been committed to this strategy really for a long period of time. This is the way they do their business. They've consistently spent, a large amount of their revenue, 14%, on research and development. So that's a key component of why they are able to succeed here. Another growth driver is going digital. And, digital is currently one of the hot trends for banking, the move to digital banking, and Jack Henry thinks they are extremely well positioned to take advantage of this with what they have labeled their Banno Digital Banking Suite. They believe that there will be thousands of banks upgrading their digital banking systems in the near future. Something for both mobile banking, your phones or your tablets or whatever, and internet banking, which really are kind of two different segments. But they know that the customers want a universal or the same kind of experience over all of those. So they work towards that in their products. So these Banno products fill that need. And these products are available to all of Jack Henry's core customers. But in addition, their future plans are that they will offer these products, these digital banking products by Banno, to all banks starting in 2023, whether or not they use a Jack Henry core processing system. So that's another opportunity. I do want to just pause here and say that Jack Henry believes their success is due largely to their employees. And it seems they treat their employees very well, because they regularly receive various awards as one of the very best places to work. You know, happy employees makes for happy customers, and happy customers generally make for happy shareholders. I think it's really all related. So let's look at the SSG. Now, what Jack Henry won't win any awards for is for fast growth, but they do get very, very high marks for consistency. You know, you can see, you know, the consistency there on sales at 6% over that whole period, and you can go farther back and it looks very, very similar. The earnings growth is also very steady. There is that blip you see in 2018 year it was, and that was through a one-time benefit from the Tax Cut and Jobs Act. So you could probably just treat that as an outlier for now. Looking at the management, we see that pre-tax profit margins have been down in the most recent 3 years, but they have been doing a big project, a multi-year project to upgrade their card processing platform. That is now complete, and they are optimistic that their margins will approach the previous levels soon. Return on equity is excellent. Again, you can disregard that 30% in 2018 because of that skewed by that one-time tax benefit, and debt is basically non-existent. So going on to valuation, I guess if there's a downside, this is it. Jack Henry is not an inexpensive stock. I did remove the PEs from 2018 because those appear artificially low because of those extra high earnings that we saw on the graph. So the current PE of 38 and some is very close to the average PE of 38 and some. So, you know, I think a PE of 38 is high. Ken knows me. I start to get nervous at about that level. But as I said, I have held this stock and I've held it through higher PEs than 38, I have to say. I believe this stock is awarded a very high valuation because of the very, very high quality of this company and some of those competitive advantages that we talked about. It doesn't look like a bargain, but maybe it looks like it might be somewhat fairly valued, and I'm using air quotes that you can't see me do, based on its history. And here's the thing, you know, I have owned this for a long time, and generally it will look overvalued and on a conservatively prepared stock selection guide, which is my favorite way to prepare stock selection guides. But consider this next chart. This is from Morningstar, and they admittedly have a different method to value stocks than we do, but I want to point out that that red line is what their analyst considers to be the fair value as they calculate it. And the black line is the price bars. And you can see that the price has generally been above the fair value line for the last 10 years. And in spite of that, in spite of the fact that Morningstar is saying, oh no, this is only a 1 or a 2, you know, possibly a 3-star stock if it is fairly valued, the stock price has continued to go up. So all I'm saying is that when the stock price approaches that fair value, as it is right now, and this is why I'm bringing it to your attention at this time frame, it might be a good time to take a hard look at the company. And that's it.
Thank you, Ann. I'll let you know that I'm a longtime holder of Jack Henry as well, and it's served me quite well. I'm very pleased
happy
with
as shareholders.
performance.
Yes, absolutely.
Very happy. We're going now to Pat Donnelly. He's going to talk about Qiagen, ticker QGEN. Your turn, Pat.
Well, thank you, Ken. Man, I love listening to these stocks and everybody's analysis. So disclosure here, I had picked up Keogen, looking at my records here, March of this year. Yeah, so I'm currently an owner of it, and it came up for discussion tonight because in my portfolio report, it's showing as being in the buy range. Excuse me, with my own analysis, not anybody else's. So do your own homework. I came across Keogen last year when I was doing a Let's Talk Stocks in our Pittsburgh chapter, and had focused on an industry called contract research organizations, which were healthcare, medical research companies. This company doesn't exactly do that, but it fits right into that area pretty nicely. So overall, you can see, as it says, it's diagnostics and research in the healthcare sector. Medium-sized company. I think last year's sales were about $2 billion last I looked. And the company splits its kind of its income streams almost in the middle, down the middle. It's split between molecular diagnostics, so it's all the way down to the DNA level, and also supporting life sciences. As you can see at the top right there, the consumables and related revenues are a nice recurring revenue, what I would call the faster type of cash generator for the company. And the instruments is the technology and hardware that they manufacture and sell and provide service for as well. So I think I'm getting the rush to move along here, so I'll continue to do that. What we see is about an overall growth. So the sales growth is relatively consistent. What I'd like to point out about this is if you go in and read the most recent financial performance about the company, they've actually increased their own guidance internally. So they've provided that they're going to have stronger performance for the year closing out. Most recently, they have settled a patent lawsuit with Becton Dickinson, BD, which is another device manufacturer, probably everybody's familiar with. And at one time in their history, the organizations shared some technologies. So now that they've cleared through that process and that uncertainty's out, you know, I think that that's a good thing for the stock. That's one of the things I like about it. Overall, the stock's not trading at its 52-week high, which is another thing I like about it. And we can see that, you know, generally, although the earnings per share and pre-tax profit are a little bit more volatile, overall the trend is up if you're patient and have the stomach for it. So I understand this is not your textbook stock that we look at here in Better Investing or Manifest Investing, but I thought it would be good, and since I owned it, I have put my money where my mouth is. So overall, what we see is that the right now the big takeaway from this table is that the PE ratio, if you look at the current PE ratio, it's somewhere in the realm of reality versus what the average PE ratio is for this company. So I'm not sure many of us would be buying a stock at 82 PE, but somewhere in the 21 area is a little bit more reasonable for us to take a look at. Let's see, what else I'd like to mention, that the company overall has a net profit margin of about 23%, which is better than average for the rest of the industry. So overall, if you look at this company against competitors or peers, you'll find that in general, it is performing at least as good as the industry, if not better, and better than more than half of its peers. So it's in the top region. I'm not saying it's the best, but it's not bad. And I think where we're at is that the analysts are sort of lukewarm on the company. So there's not a lot of hype around it, which I kind of like, because when you get a lot of hype around it, the price is driven up. So I like to get on that escalator before it starts going up. We've got the uncertainty of the lawsuit. That's been settled. I like that. And I like the fact that the company is providing its own guidance and saying that times are better in the future. COVID's been good to the company. They've emerged stronger. They had a CEO turnover in 2019, if you were wondering about the big dip there. That was a failed takeover by Thermo Fisher. So there was a lot of turnover in turmoil in the company. We had the takeover, which was friendly, but it didn't work out. And also the CEO that had been there for a few decades left the company all at that same time. So 2019 was definitely a pivotal moment for this company. So if I haven't talked you out of it at this point, I'd like you to consider at least taking a look at the QGEN and or a company in its same industry if you're looking for some healthcare, medical, or research technology exposure. So I'll be short and sweet with that one.
Thanks a lot, Pat. We appreciate it. We're going on to Mark now. He's going to talk about a stock that all of you know, Visa, ticker V.
All right, just a couple quick pieces of housekeeping. Can you use the word raconteur when you introduce Pat tonight? In the realm of, in an investing context, I think I'm owed some royalties for that.
Okay.
Second of all, I want to confirm that Cy has basically been en fuego here lately, not only winning the World Series, but his selections for the roundtable are off the charts. Just, I think he may have changed his middle name to EPAM here over the last couple of years, and that's worked out pretty well. Third, I also want to disclose that I own a few shares of Jack Henry. Apparently everybody else does around here also. And fourth, Ken, you know what makes me sad?
What makes you sad, Mark?
I'm not en fuego when it comes to these panels like Cy has been. In the selections made 6 months ago, I think I'm in 15th and 16th place, and that would be fine if there were like 200 entries, but there are 16 entries. So that kind of makes me sad. So that's the start of this story. So up at the top, what you're looking at is just a really quick sort. I'm looking for a good situation on a company where it's got a lot of tailwind and go all the way to the right. And what I'm basically looking for is a company that has a lot of upside potential. You can actually find published estimates for the next year, a 1-year situation for these companies, and calculate, how much upside do they have from where they're currently at. Now, Sharp's compliance is pretty compelling. It's one of our best small companies for this year. Magnite is also pretty good too, but I'm just having trouble generating the type of enthusiasm I need for some of these. There's some really good studies. Ann's going to cover Medifast here in a few minutes. That's a great story. Semler's a great story. So there's some really good stuff there, but I'm just not feeling it. And the fact that I'm basically in next to last place and last place here recently, I'm just consigned to, I don't need to win. I just want to finish somewhere in the middle of the pack. So I think in a market like today's market, something that you really know, a company like Visa, and I think almost everybody here listening has a plastic card either in their purse or their wallet that is affiliated with this company. And they're quite innovative, certainly not new kids on the block. They are the largest processor of credit transactions in the world. They are leveraged well into any of the e-payments and that kind of stuff. So they're really into it. You can see that stock price chart from Value Line going very nicely from lower left to upper right. And it's just, it's an A++ company, financial strength wise, and certainly not a whole lot of surprises. And yeah, it's going to have its dips, but you look at that page and you don't see a whole lot of dipping and zigging and zagging. So the fact that it's, you know, in the range that it is, we're going to look at here in a second. Again, not incredibly sexy, but I'd kind of like to end up in the middle rather than at the bottom of the list. So go ahead, Ken. Here you go, up straight and parallel. Again, much like Jack Henry, not incredibly sexy when it comes to the growth rate, but we are talking about roughly a 10% growth rate over time. Earnings very steady, a little bit of a hiccup with the pandemic, but it's basically up straight and parallel across the board. I don't think I need to say much more. It's in the top percentile for company quality, improving profit margins. They also do quite a bit of R&D. They're, like I say, they're into all kinds of stuff. So when I see a projected annual return of about 10%, you know, in a market that's projected to return 6 to 7% on the average stock, and this type of consistency, I'm just going to throw down the gauntlet and say I'd kind of like to not finish last, and I don't think we'll finish last. Might not finish first, but I don't think we'll finish last with Visa. Again, it's the type of company that we've wanted to have in the roundtable for years, and nobody's ever brought it. So we probably need to rethink that, Ken. So I'm going with Visa for now.
Thanks, Mark. Short and sweet and to the point. I'm going to talk about LGI Homes, LGIH, and Mark, I had some of the same thoughts. I have not been doing real well in these stock picking panels in the last year or so, and I thought, well, let's pick one that maybe can finish in the. I was aiming at the top third, Mark. So let's see how I do. Okay.
Well, you have to pick a retailer that doesn't have any open stores, and that gets you there.
Okay. Here's a visual analysis for LGI Homes, and especially since 2014, I think I can make a real strong case for up straight and parallel. This is a medium-sized home builder, and they basically sell to the new home buyer, just starter homes and first move up kind of homes. They sell at the lower end of the market. Very rapid growth from 2013 to 2021, extremely rapid growth, and not only in numbers of houses sold, but in geography. I'm making the point here that population growth has outpaced home construction for 20 years. That's a difficult stat to absorb, but for 20 years, housing growth has not kept up with population growth. You can see the great decline after the Great Recession. Housing was down 55% from 2006 until where it is right now. And we're going to need a lot more houses as we move towards more and more household creation. LGI Homes has made it into the category of playing with the big boys now. This is from a list of the 10 biggest home builders in America, and LGI has moved into 10th spot right now, and it's moved there again primarily by selling to first-time home buyers. LGI doesn't offer a whole lot of choices when you build a home. They'll put together a community and they'll put together 5 or 6 spec homes within that community, and that's what you're going to buy. You're not going to be able to choose countertops and the different kinds of flooring and all of the different finishes that you might do in a more expensive house, but you're going to get a well-built house, and it's perfect for a first-time home buyer. I've set sales and growth at about 15% for both revenues and earnings per share for LGI Homes. And that is right in accordance with almost all the different data that I can pull out from the different sources. And I'm looking at the management section of the LGIH SSG, and I'm saying to myself, green, 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 that's really wonderful. I'm looking at pre-tax profit margin moving in the right direction, And a little bit on the high side for home builders, I'm looking at return on equity moving in the right direction and a little bit better than the majority of home builders. And I'm looking at debt to capital for LGI. And even though the 5-year average is 46%, believe it or not, that's the lowest debt to capital ratio among the home builders, or at least the major home builders in the country. This industry traditionally carries a reasonable amount of debt. I'm looking at the rest of my SSG. Home builders tend to have really low PE values because the barriers to entry for competitors are really very low. There are over 10,000 different licensed contractors building homes in the United States, and that includes over 200 different home building companies, either trading publicly or being held privately. We're looking at an SSG that I put together using what I think are extremely conservative numbers, and I'm getting a buy with a 10-to-1 upside downside. I'm using an average PE ratio of only about 9.5. That makes it certainly a pretty low bar to have to jump over in order to make a profit. And using those numbers that I'm talking about gives me a projected return of just under 20%. That's using the average PE of 9.5. A shortage of starter homes and the demographics in this country, which place the largest cohort of population at their mid-30s, says that we're going to be needing homes for a long while. My conclusion is that the home building industry, while it's certainly going to have some ups and downs depending on material costs, depending on labor shortages, depending on interest rates, but I think the trend generally in the home building industry is going to be to the upside because we just need a lot of housing stock, especially considering the fact that so much of our housing stock is nearing an age where it's not going to be suitable for living for the next 20 or 30 years. I think it's going to stay a strong industry, so I'm suggesting LGIH. That's a home builder, and I like it a lot. Let's go through our lightning round, and folks, let's try to keep it to 1.5 minutes apiece on your lightning round, okay? Kim, give us your lightning stock.
My lightning stock is going to be PayPal. That's pretty well up straight and parallel. They got a little overvalued. The RSI is, as Mark talks about frequently, the RSI was down to 22. The price target is 208 to 434 with a midpoint of 321 at 18 months. Take a look at it, folks. Thank you.
Cy, your lightning stock.
All right. I've stayed with retailer on the first pick. This is picking up, I guess it was last fall, so about a year ago, I did a competitor of Lam Research, AMSL lithography. It's a supplier to the semiconductor industry, which I guess seems to be a theme that I've kind of run into. Did consulting and software developers for business back office with the CTSH and EPAM and those. Now we're looking at suppliers to semiconductor industry with Lam and, like I said, AMSL and MKSI. MKSI is in a different realm than Lam and AMSL. They do the actual wafers. They manufacture the silicon that Skyworks and Intel, all of the chip makers use. And you could see, again, a relatively steady history. And what kind of caught my eye is just a general screen on manifest. But if you look at the manifest chronicle, you'll see quality going up, you'll see potential return going up, and you'll see some level of long-term price increases that have flattened out a little bit over the last few months, which looks like it might be a buying opportunity.
Thank you so much, Cy. Charlene, it's your turn. What's your lightning stock?
Mine is Western Alliance Bancorp. It's a regional bank. It's a mid-sized company. It's in the financial services as a sector. And of course, the industry is banks regional. I tell you a lot of good stuff about it, but we'll go right to the slide. And here's a good example of what we'd like to see as investors on this SSG history graph, up straight and parallel. Western Alliance's revenue growth at 19% over 10 years and its earnings growth at 34% during that time frame was something we liked when we started buying it back in 2019. Morningstar estimates for future revenue and earnings indicates continued strong growth on both the top and bottom line. I don't think that's on the chart there, but they show upward projection there. Forbes has named this bank one of the best banks in America, and it's been on their list for several years now. If you look their history on pre-tax profits, return on equity, debt, and also return on average assets is excellent and has been for 7 years. The return on average assets is an extra line that you'll find on the SSGs for banks. Banks that achieve 1.25% are considered good, and those achieving 1.5% are very good, and only 4% of the banks can do that. And Western Alliance has been doing that for a long stretch. Their third quarter earnings report in September exceeded analyst expectations and have done so the last 4 quarters. The average high PE for Western Alliance is around 14.5%, and their PEG ratio is near 1 at the current price of $119. I added the dividend in when I figured the PEG. So on that note, WAL just increased their dividend to 35 cents per quarter. The company has an average price target by analysts of $140 with a high of $150 and a low of $131. Long-term investors looking for a great company at a fair price may want to study Western Alliance, and our club has owned this since 2019. Thank you.
I want to tell you, Charlene, that 3 of my clubs are proud owners of Western Alliance as well. And let's go to Medifast.
Okay, well, already you guys know Mark, spilled the beans. No, I'm kidding.
It wouldn't be a panel without bean spilling.
Right. I am talking about Medifast, and this is a company that they deal with products about weight loss and weight management products. So if you're looking at the chart there, and you probably all are, you see that there was this big change in about 2017. It was in that year that they created a new brand called Optavia, I guess you say it. I'm not sure if that's pronounced correctly, but that's focused on the coach-based business model. And they had this before, but they really emphasized it in 2017. They claim they changed their business model, and you can see the results. But that coach-based business model is one that, if you're a client, you become a coach, and then a coach brings in new clients, and then those new clients become coaches, and they bring in new clients, and so on, and so on, and so on. The more coaches they have, the more clients they have, and the more product they sell. And that is contributing dramatically to that increase in both sales and earnings. In fact, if I looked at some of the data, they went from 15,000 coaches in 2017 at the launch of this to 61,000 at their most recently reported quarter, which was just last week. 300% increase in less than 5 years. That's crazy. Time will tell if that level of growth can continue, but the fact is there's plenty of people that are looking to lose weight, improve their health, all those good things. And this is a fairly small company still. Oh, one more thing. The company itself has a growth goal that they state right on their website to grow their sales at 15% annually over the long term. So that's a good place to start. It hits all the quality checks, great cash flow, great graph, second section all looks good. The part that gives me pause is the valuation. It's improved a little bit over the most recent couple weeks, but the current PE is 16. The average PE over the last 5 years is 23. I'm not sure what that's telling me. Is it a real bargain or is there something I don't know? It looks good on paper, folks, so do your own research on that one. Medifast.
Thanks a lot, Ann. Really intriguing stock. Coinbase, Pat. I can always count on you for a new addition to our knowledge base here.
Hey, there you go. If you thought Stone was a good ride from 20 to 100, of course the key is selling, right? So, hey, we're all about cryptocurrency these days, and I'm not just about up, straight, and parallel. I'm about who can be more up and more straight and more parallel. So here we go. Although the history's short, why not feel like you're getting in early on a company, or use this as a case study, or use it as a benchmark for other cryptocurrencies? Why not be in the middle of the crypto technology transactions? Because Coinbase is a fintech company, financial technology company, provides end-to-end financial infrastructure focused on building the crypto economy. Platform enables 43 million retail investors, 7,000 institutions, and 115,000 ecosystem partners in over 100 countries. Excuse me. It's a one-stop shop for hedge funds, money managers, and corporations for accessing crypto markets. They provide developers access to their technology so they can integrate it. And again, if you've ever heard of a company called Market Access, MKTX, they were a company nobody heard of, and it exploded because basically they're an exchange. Coinbase is very similar conceptually. It's an exchange. They're in the middle. They don't care if you're using Ethereum or Bitcoin or Dogecoin or whatever. They're in the middle. So they get paid when you buy, they get paid when you sell. Being the middleman's a good thing, and I respect that. So, short history for your consideration. And if you can't commit to a specific crypto but want to be in that space, COIN, C-O-I-N, may be something for you to consider.
Thank you so much, Pat. I will tell you that when you make a mention of a company like this, I like to go and take a look at it real quickly. So when you sent me this name, I went to their website. There's a lot of information about what all this crypto stuff is talking about. And if nothing else, you might go to the website just for educational purposes to read some of the different articles that are posted there. It's a really full of a lot of different articles and graphs and suggestions about what cryptocurrency is and what it might be. It's a good place. Let's move now to Mark. Tell us about your lightning stock, Mark.
Well, I'd like to switch to the Solana cryptocurrency. Call it audible. If I had chosen, I chose that one for the morning brew stock contest. It's up 18,000% in like the last couple months, and I would have won that contest if it hadn't ended. Anyhow, we're back to we're back to. This is the company that has tormented me for the last couple of sessions. I have put it on our list, and they've had trouble with the COVID batches and stuff, and you guys have read about them. And I think they're getting the short end of the stick here. And you can see that it's obviously not up straight and parallel. They do have their bumps, but this is a viable company, and it's not being treated that way. So it's down huge. It's down huge from where we first mentioned it. It put me in last place, and I'm going to be stubborn about this one. Next slide, Ken.
You know, Mark, if we were teaching face-to-face right now, I'd be reminding you of the definition of insanity. You know, doing the exact same thing time after time and expecting a different outcome.
Well, this could be a different story now.
Maybe.
It could be. Well, in honor of Hugh McManus, every once in a while you can find an opportunity, and I'm an optimist. These guys are sullied and loathed. Hugh has a thing he calls the loathed index. You know, if you can find a company that is hated and beat up so badly, and you've got enough time to wait it out, you can definitely do okay. They're really having trouble at one manufacturing facility, and they manufacture a whole bunch of stuff. They have revenues, they have earnings that are not related to this area that's getting all the attention. And this is where I'm going to get a tiny bit political. I hate yellow journalism. And you read that headline and you watch a stock price drop 50% overnight. And then you dig in a little bit deeper and you find out the headline doesn't match really what's in the story, because it wasn't a $600 million deal that's canceled. They basically just short cycled it and had basically a $100 million hit. And the very next day, they signed a new contract. Yet that is not being reported by anybody. And the New Yorker and the New York Times are being incredibly irresponsible, in my opinion. And eventually this thing has to come around. So again, it's been cut in half. It does not deserve it. There's the picture. Yeah, it's going to have a COVID wave. But they have earnings. They make a whole lot of other stuff other than that COVID batch that they're infamous for. And again, I think that with a little bit of time, there's a chance that my stubbornness will pay off. Otherwise, I'll just be whining about this 6 months from now.
Okay, thanks, Mark. I'm going to end the whole thing with a very atypical stock from what I normally choose. I've watched a lot of my colleagues on the panel tonight use Up Straight and Parallel, and I think we've given you 80% or more stocks that are good, solid, better investing kind of consistent growth stocks. I'm going to point you towards a company that as yet has no earnings of any kind. It does have a sales history, but no earnings of any kind. And I'm going to indicate that if you read the literature about this company, they are expecting earnings to begin sometime in 2022. That's, 3 months, 6 months, 9 months away now. So we might be starting to see this company actually have positive earnings within the next year. The name of the company is Twist Bioscience, TWST, and they make synthetic DNA, which is used by all kinds of biopharmaceutical companies, all kinds of research companies, all kinds of universities that are doing research into the human genome, that's used all over the planet right now in this rush to discover different ways to tailor make medications to fit your individual genome. Not just a cancer drug, but millions of different cancer drugs based on your particular genome, your set of DNA markers. Right now, we can make synthetic DNA in these physical tubes on the left of this picture, and we can make them in 96 well plate units, and that makes one gene. This company has discovered a way to put this same process onto silicon chips where it can make 1 million oligos per chip, and that gives it the ability to make about 96,000 genes during the same time period that traditionally we were making a single gene. This is going to open up the market for this synthetic DNA, and you can see some of the different types of people that are waiting to be able to use some of these this synthetic material. I just think that it's a really interesting thing to consider. It's quite a website, and if you're interested in this, please go to their website and take a look at the investor presentation. No revenues, early stage investing, but for those of you that are experienced and have a decent sized portfolio, maybe you have a little bit of room to play around occasionally with something that's going to disrupt human nature as we know it. Here's our picks, folks. They're going to be on this slide, and this slide is going to be part of the presentation that's posted on YouTube. Again, it's the Manifest Investing Roundtable YouTube channel. When you go there, if you subscribe, then you'll get emails whenever we post new material to that channel. If you'd like these slides where you can read some of these lists and process some of these lists, all you need to do is send an email to markr@manifestinvesting.com, and Mark will see that you get a set of the slides from tonight's presentation. We are so happy to have so many of you here this evening. I hope our panel had a great time, and I want to thank you from the bottom of my heart and Mid-Michigan's heart for helping us out tonight. This has been a great conference, and maybe we'll do it again someday, okay? Good night, everybody.